This is what's bankrupting Florida buyers, and most people never see it coming. The line items are legal, invisible in the marketing, and they will wreck your returns if you underwrite them wrong. Today, I'll show you the 5 costs that crush cash flow in Florida and how we can structure new build rentals to avoid them. Florida growth is real, but carrying costs are rising faster than most performers account for. If you model with yesterday's taxes, generic insurance, and no special districts, your deal can flip from positive to negative after closing. Insurance is the boss battle. Old roofs, weak wind credits, and coastal exposure can turn a good deal into a loser. The solution? Build and spec for insurability. Wind mitigation, compliant roofs, shutters, clean documentation, new construction upgrades. Price the actual renewal number, not a teaser. Flood pricing is now more granular. Elevation, distance to water, prior claims change everything. The solution for that? Prefer higher elevation, smarter drainage. Also look to see what type of flood zone the area is it in, because there are different degrees of flood zones. Some are more minor, some are more major. And if you get stuck with a flood area, sometimes if you're working with certain builders, you can ask for them to actually pay your flood insurance. If you want the water, model the premium up front and design the living space above base flood. That's what they do with new construction. That's why the lower assessments on that type of insurance. Community development districts fund roads and amenities through annual reassessments that last for decades. If you miss them, your cap rate is fiction. The solution? Put the parcel's district, the remaining bond balance, and the operation fees. Treat it as a fixed line item in your underwriting. HOAs can look small on paper and then spike with special projects or thin reserves. The solution for that? Read the budget, reserves, and minutes. Find out where the HOA actually is. Ask for the financials. Are they healthy? Are they not? Are they behind in dues? Are there special assessments coming or big repairs? You have to look for this. Prefer lean amenity communities. This is something that keeps the dues investor friendly. And what we've learned in our building experience, it's not always about the amenities, it's about the affordability. So when you can look for more lean amenity communities, it's going to create more affordability, which creates bigger drive for the tenants to live there. If you budget off the seller's bill for your taxes, you are just guessing. After the sale, that's when the assessment resets. So use the county estimator with your purchase price and lock that number into your pro forma. Now, most areas in Florida that I've been building in and have invested in do not actually go to that full purchase price. There's usually a lower amount. Still, if you do your numbers at that county estimator for your actual purchase price, it's going to possibly leave you more room and a little bit of a buffer for a nice surprise of extra cash flow. So fix and flips with unpermitted mechanicals, windows can cost thousands to fix and delay tenants. This is a real issue, especially when work has been unpermitted. So what's the solution? Go with new. Look for the permits, look for the CO, hand over the paper trail and go through it. You want to know that if you buy resale, check the permit history to make sure that a roof wasn't put on the weekend by some non-contractor, and make sure you get it all in writing. Here is how you quietly lose money. You add a realistic insurance quote of $200 a month, an HOA at $150 a month, a CDD at $150, and then a tax reset worth another $150. That is $650 per month gone. So your 6 to 7 cap now drops down to the low 4s. One oversight can wipe out a year's worth of returns. So false hope check, saying it hasn't flooded in 100 years or the taxes are low, that's not underwriting. Statute, schedules, maps decide your cost structure. Verify every line item before you celebrate a cap rate and close on the property. At Southern Impression Homes, we design for insurability. We verify CDD, HOA, and tax at the parcel level. We avoid low elevation traps like old fixer-uppers can sometimes get you stuck in, and we package property management and a 210 warranty to reduce early year CapEx risks. So if you're an investor, some real strategic advice: get a strong quote from a real insurance company, someone other investors are already working with, and somebody that has actually been in your area already insuring properties. And that's for both homeowners or landlord policies. Also, make sure is flood policies applicable. Make sure you review the flood maps. A good insurance person will have that. They'll also understand wind mitigation credits. All these things are why we work in new construction, but they can go to lowering your costs on that monthly insurance premium. And treat CDD and HOAs as fixed costs and demand the bond amortization schedule. Use the tax estimator for year one. Like I said, those taxes might be below your purchase price. A lot of the times they are, but if you estimate at that full purchase price, you give some buffer and hopefully a nice surprise will ensure with your cash flow. And remember, prefer new construction with closed permits and documented wins credits. If you're a real estate agent trying to help your people get great deals, lead with insurance and taxes, not countertops, especially for the investors. It's about the return, and getting the insurance right and the taxes right are absolutely pinnacle to those first few years of rental growth and putting the property on the right trajectory. Again, pull permit history, non-ad valorem assessments, and the HOA resale package before showings. Make sure that HOA is healthy for your buyer. You will save the clients from bad buys, and that will win you repeat business. So looking long-term, Florida demand is still strong. Last year, on what was considered an off year, there was over 470,000 people in net migration. That means the state grew by almost 500,000 people when people had said the migration pattern here had stopped. Just not true. And the winners are going to be the operators who control costs and understand the markets that are still growing, which are the affordable markets. So look for properties that are built smarter, that are on higher ground, so you get those insurance premiums reduced, and make sure everything is disclosed so that you know that there's nothing unpermitted, things have been done by the book. And if you do that, you can build a rental portfolio that will perform through storms, rate cycles, and even down markets so that you can have the cash flow and equity growth you want for you and your family in the long term. And if you're looking long term and truly want to build a portfolio with new construction and leave the headaches behind, watch some of my next videos because I'm going to be going deep into how new construction outperforms old fixer-uppers and how you can capitalize that, especially in year 2026 and 2027.